Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today is Andrew Holland of Avendus. Andrew, great having you. Thanks for joining in. Hope all is well.
All is well. Thank you. And thank you for the opportunity, as always.
The pleasure is ours, Andrew. One would have to say, Andrew, that for most people who are believing that at circa 17,500 for Indian markets or for the world markets as well, if the scene was looking difficult, and an arguably a sell on rise market, we've fared reasonably well for equities as an asset class in the October to December quarter. How do you see the landscape currently?
So yeah, you're right, Niraj, in terms of that. I think the markets defied, I think, a lot of expectations, including mine, in terms of, I think the global events have been easier to kind of predict to some extent. But the resilience of the Indian market is, I think, has caught us all by a little bit by surprise, of how well it's done, given the valuations that we have currently. So I think going into next year, this kind of, well, first of all, there's a hugely consensus view now. We've talked about it over the year, in that, once the Fed stops increasing rates, and when people start looking through the recession, where would they find growth? And that's going to be emerging markets, and that to a T, everyone is talking about now. So that always worries me, because when it's consensus, something different usually happens. But let's see if that is the case. So I think there's three camps. There's those in the kind of recession camp, those in the deflation camp, and those in the stagflation camp. Very few in the stagflation camp. And I think that's what's going to just trouble the markets in the first part of the year, because we're all still kind of working out whether inflation's too sticky, which will probably lead to stagflation. The bond yields are telling us that recession is going to be a lot more severe, and therefore you will see product prices and commodity prices falling, which is obviously deflationary. I'm in the camp of recession, a little bit more harder than people are expecting in the Goldilocks scenario, and that will lead to deflation. So that's the good news, but the pain still has to be there. And I think the recession, in terms of how severe it will be in the US, is still to play out. And I'll tell you something, Niraj, in that, if you think about the rate increases and how quick they've been over the last 6 months, it hasn't, and we know that it takes 6 months to start to feed through to people's wallets and so forth, and spending habits. They've been so quick, I don't think people have been able to catch up, and I think they're catching up now. If you look at some of the data from the US, credit card spending is ballooning again, savings rates falling quite a lot. So we know, and if you speak to people in Europe or the US, we know a lot of their wallets now going towards food, energy, and mortgages.
Yeah, Andrew. So could it therefore turn out, as things stand? I mean, who knows what the future will bring? But could the hypothesis be that because the US has raised rates and it will start impacting, the US enters into a bit of a recessionary phase, whether it's severe or otherwise is one question. So the first half is marred by that. But because now the Fed would have ammo, it sees the US going into recession, it starts making a large pivot again, and that might be positive for risk assets in the second half. Could it be as simple as that?
It could. I mean, that's what the market's saying, right? That it's that simple. That you increase rates, you stop in sometime in the first half, and then as the recession comes along, you start to reduce your interest rates, and that can only happen if you manage to win the battle of inflation as well, right? And the Fed's target there is 2%. So that's going to be a little bit more of a battle, but the market will look through that and say, okay, it will happen at some point. Therefore, where is growth going to come from, and how's it going to come, and how's the world economy going to recover? And I think that's what the market will focus in on. Now, does that mean that this big flow of funds goes to emerging markets in the first half of the year? That's the question, right? Now, if you're saying, let's say your worst case scenario, or the scenario you mentioned, that it's a little harder than the market expects, means that, because of that, your exporting countries like the China, the Taiwans, the Koreas, themselves going to find the problem, right? We saw the China data the other day. Exports were very lukewarm, right? I mean, hardly anything. That's going to be, the problem, I think, for India as well in our exports. So you go back to a balance of payments, current account deficit, all of these factors, I think, will play through for India in the shorter term as well. So I know there's this whole decoupling theory, and I'm not against the kind of long-term prospects for India, but I don't think we can decouple from that. And there's one other thing, Niraj, and we talked about it many, many times, is the unintended consequences of these interest rate hikes, which we still have more to come. We saw it a few months back in pension funds in the UK. We had the kind of wobbles about Credit Suisse. We've seen a huge fall in the crypto markets, and as we know, as you reported on your news, that Blackstone have stopped redemptions or reduced redemptions in one of their property funds in the US. So what's out there that's going to have a problem because of liquidity drying up or higher interest rates? And I think that's the one thing, because it'd be financial. It won't be economic. It'll be financial.
Yeah. So Andrew, how do you position yourself for such a scenario? I mean, we are end December. Let's assume the last 10, 15 days, there is lack of action across the world, presumably in India as well, the volumes come off. How do you position yourself for the new year?
So, we have been deploying more money into the markets because obviously the momentum is there. The Goldilocks scenario is there. So that plays well for the markets. But I think going into January, I think we'll probably be a little bit more sober. Christmas maybe has come early for us in October and November. And maybe we'll see that consolidation. I think the way I'd want to position going forward, if the prediction I made that, it's recession then deflation, then I still want to be in the banks and I still want to be in autos. Those are the two key sectors I want to go for. But Niraj, I think next year is going to be tough in terms of index returns. Now it might be plus or minus 5%, but I think it's going to be a tough first half. So I think it's going to be the themes. It's something we talked about before. The themes that will make you money next year, rather than the index will make you money.
Too much of a stock-specific market, presumably. Now, Andrew, again, you yourself said at the start of the interview that consensus at times scares you, right? When I hear everybody on the street, articles, interviews, reams and reams of social media tweets about how banking in BFSI is the safe, sure spot. Everybody's parked there. Can it be different, that consensus will prove to be very correct and banks will essentially be the holding fort in the first half in India?
So I think the one area which is continuing to excite investors is that the banks are coming into this new growth phase, with not being saddled down with the non-performing assets. Now, obviously, in a few years' time, we could go back to that cycle. But at the moment, as kind of Uday Kotak said, we're in that Goldilocks scenario, right, where we're getting growth, we haven't got a baggage to look at. So I think the banks will play out. I think the only thing that I would say would concern me for the banks, obviously, would be, if you do talk about a kind of a sharper fall in global growth than they're expecting, then that could have an impact on, as I said, balance of payments, current account deficit. Therefore, borrowing costs might have to rise a little bit more, and then pushing up rates a little bit higher, slowing growth. And I think you're already seeing, Niraj, forecasts for next year for GDP, real GDP growth of, I've seen as low as under 5, but let's say it's between 5.5. That's a big slowdown, right? From your 6.5, 6.8 that the RBI is saying. So that will have an impact at some point. So if all of these collide together, then the banking sector might be a short-term underperformer because of that, because it's had a great run. So the people will take some money off the table.
I wrote a piece yesterday, Andrew, on the other big thing in India, which is consumption, and how it is seemingly such a sharp K-shaped recovery, wherein the urban discretionary is the one which is performing, and some signs of a pullback in rural in the last 6 months, but nothing quite concrete, at least on the face of it. How are you, again, kind of reading into this from an investing perspective? Is the pain in the price for the rural focused plays, and is the strong performance in the price for urban discretionary, or do you think there is still some miles to go for both?
See, I think there's a couple of things. One is, it's where you're looking at that spending. Now, I don't know if you're going on holiday at the end of the year, but I'm sure if you are in India, you'll probably find it cheaper to go outside of India. So the prices in hotels and travel is extraordinarily high. But we're all having to pay it, right? Because actually, I think there's also problems in terms of getting visas outside of say Europe, and there's a big waiting list, right? So I think that's probably keeping people here as well. So that's a discretionary spend, which I think is probably not going to go away. I think we've all want to kind of do things, have more experiences. I think where I'm coming from in terms of that first half scenario, I'd rather being kind of the staples, the FMCG stocks, because that's where I think the rural spending will be more towards, rather than obviously other discretionary spending at the moment. So I think I'd probably go for that safety. And if I'm right that commodity prices will come down, then it gives these guys, the FMCG companies, that kind of margin expansion or margin comfort as they kind of increase volumes as well. So I think I'd rather be in that space than pure consumer discretionary. Again, I think it's where you want to be. Would it be autos? Probably not in the short term, but would I be maybe looking at hotels? Yes, definitely.
Oh yeah, I mean, they're booked out, and the rates, as you said, are just sky high, Andrew. But it's interesting that you mentioned the margin of safety aspect and the margin improvement aspect, because which brings me to a note that I was reading today. I think it was from Motilal Oswal, wherein they are talking about the kind of expected margin recovery that could come into multiple pockets, including cement. Now we know that infrastructure is the thrust. Cement has had a slightly tough last 12 to 18 to 24 odd months. You reckon a recovery is around the corner, volumes, margins, what have you, and could it be positive for the pricing or prices or the fortunes of these companies, or would you rather stay there?
No, I think cement is obviously it's a play. If you look over the years, there's certain times when they increase prices, and I think this is one of the times when they'll start increasing prices. So I don't think there's anything new in that. I think the bigger theme is obviously that with the new entrants coming in, is how quickly this overall sector will continue to consolidate into just 2 or 3 big players. And I think that's the way it's looking. So then you know where the pricing power is, right? It's a bit like the telecom sector. There's 1 or 2 players, and that's about it. And they have the pricing power whenever they want to use it now. It just it depends on how much pain they want to inflict on each other. So that's what the way I see the longer term part of the cement sector going. But that the whole infrastructure spending again, I want to play it slightly differently, and it's something we talked about before, Niraj, in that the global trend will be towards those sectors where there's either a supply constraint or an opportunity. Now, either the government fills it or corporates will fill it. So it's going to be in this it's going to be in these industries which India is falling short of supply, and that lends itself to different type of capex, right? And it's going to be more kind of high end. So the kind of if I look through to the L&Ts and the BHLs of yesteryear in terms of capex, I'd probably be looking more at the ABB, Siemens, and so forth, in terms of more kind of technology-driven capex going forward. So I think that's one of the themes that I think will come through, and it's a theme that's going to be global. It's not going to be just for India.
And actually, I just wanted to understand, and last couple of questions. I'll end with football, of course, but before that, the interesting conversation that I'm having is with themes or companies which have largely been neglected thus far, right? So we did a conversation with, defense is not neglected now. If anything, it's right in the front and center. But for the many years it's been neglected. We did a conversation with 5 or 6 defense companies back to back, and all of them are talking about very strong order books and much higher than the current order inflow possible in the next 3 to 6 months. So the order booking is there. We're talking to railway companies, and they are seeing some serious order inflow, much higher than the annual revenues combined for the next 5 years. Now, my question is, how does a large investor like you approach some of these themes, which have the issue of the government largely being the only buyer?
Yeah, the problem in the defense sector is there's very limited players you can actually kind of buy into, and even those which are listed, are part of either a larger part of an organization, or if they are listed, they have very limited, and I'm saying very limited interaction with analysts and fund managers. So it's very difficult to get a good, clear handle on what's really happening there. So it's a global kind of theme that's going to play through. I mean, we saw Germany's how much they're going to spend in defense going forward. So it's one of those where the defense companies, but you're part of a larger. If you go for the larger companies, you're part of a larger part of their business. So it's still a small part of their larger business. And the transparency, unfortunately, is very difficult, right? Because it's government contracts, it's security as well. So it's a tough one to kind of find that right vehicle at the moment. As regards, the kind of the infrastructure and trains and everything, that's why I'm saying I think Siemens won one of the contracts from the government, for the railway. So that whole area is going to be about technology and who's there and who's got the ability. So that's why the kind of ABB Siemens kind of fit in terms of new offices, high-tech offices, high-tech factories, robotics, so forth and so on, is where you should be.
Got it. Andrew, final question really. It's the climax. We have the round of 8, then the semis, then the finals. Can't not talk about football. I'm sure you must be having something up your sleeve about going to Qatar. So tell us, what is it that you are anticipating in the World Cup going ahead?
Well, I mean, I think everyone has a favourite team, and coming from the UK, obviously England's got to be mine. So if I had to kind of, for a final, I'd love it to be England-Brazil. I'd kind of love it to be England versus Morocco, if you know what I mean, because that might be an easier team to play. But I think England-Brazil would be fascinating, and I think the world would love it. So I'm hoping I've got tickets for the final, so I'm hoping England will be there. So and I'm heading off this time next week. I'll be heading off there.
Yeah, but they have a tough one against France coming up, Andrew, and France are playing near peak currently with some stunning players. So it's a tough one.
No, it is, and I agree. But the other thing I would say, apart from Mbappe, a lot of these players have played in the Premier League, so they're pretty well known to the English players and who have played against them. So I'm hoping that that's one fact which will help the English team. But I think I just hope it's going to be a good game. Not too kind of defensive on both sides. And obviously would love England to win. It's a good chance. If you could do that, the confidence would be sky high going into the semi-finals and hopefully going one stage beyond what we did in Russia when we lost to Croatia in the semi-final.
Yeah, well, it'll be interesting to see if England faces, if they beat France, if they face a Sans Cristiano Ronaldo Portugal, and then move on to the finals where they hopefully will meet Argentina. But you never know who comes up there. I reveal my favorite team as well. I'm hoping Messi gets a final big exit, swan song before his exit out there. But it'll be interesting. Andrew, we'll look for you in the stands if we can spot you in the finals. And we hope you have a great time there. But thank you so much for talking to us today.
Thank you again, Niraj. It's always a pleasure for me.
Likewise. And viewers, thanks for tuning into this edition of The Talking Point.